$920 million. That is the exact figure JP Morgan Chase paid to settle charges of rigging the precious metals market through a practice called spoofing, the largest trading penalty in the history of the Commodity Futures Trading Commission. And every major financial outlet covered it the same way. Justice served, problem fixed, move along. But here is what nobody told you. That fine was not the end of a scandal. It was a receipt, a confirmation, stamped and notarized by the federal government itself, that the price of gold and silver you see on your screen has been artificially engineered for years. And the engineering has not stopped. It has accelerated. In the weeks since the most recent coordinated sell-off hammered precious metals futures, something extraordinary has been unfolding beneath the surface. Central banks are purchasing gold at levels not witnessed since the late 1960s. Physical coin dealers are reporting multi-week delivery backlogs. Premiums on sovereign-minted silver have climbed even as the spot price cratered. The price printed on the COMEX ticker and the price you actually pay for an ounce of metal in the real world are diverging at a rate that the existing market structure cannot sustain indefinitely. This is not a story about gold bugs or conspiracy theories. This is a story about two markets, one made of contracts, the other made of atoms, and the mathematical certainty that they cannot stay disconnected forever. One of them is lying. And when the truth reasserts itself, the consequences will reach every bank account, every retirement portfolio, and every government balance sheet on the planet. To understand how we arrived at this fracture, and more importantly, what it means for your money in the next 12 months, we have to start with the mechanics of a machine that most investors have never been shown. A machine built to move billions of dollars in seconds, trigger cascading sell-offs on command, and manufacture a price that has almost nothing to do with the metal sitting in vaults. That machine has been running for decades, but the fuel that keeps it operational is running out. The futures exchange was designed as a hedging tool for miners and manufacturers, a way to lock in prices for metal that had not yet been pulled from the earth. What it has become is something entirely different. For every single physical ounce of gold registered for delivery in exchange warehouses, there are now hundreds of ounces worth of paper contracts circulating above it. This leverage ratio transforms the futures market from a price discovery mechanism into a price determination mechanism. A small number of bullion banks can flood the order book with massive short positions, billions of dollars worth of sell orders, and do it in the span of seconds. The timing is surgical. These dumps consistently arrive during periods of thin liquidity, particularly overnight during Asian trading hours when fewer participants are active. The sudden wall of selling triggers stop-loss orders, automated instructions set by technical traders to exit positions below certain price thresholds. Once those thresholds break, the algorithms that manage institutional money pile in, selling without discretion, accelerating the decline in a feedback loop that was ignited by design. Gold drops $50 in minutes. No breaking news, no shift in economic data, just a manufactured cascade. Retail investors see the red candles on their charts and interpret catastrophe. They liquidate. They sell their ETF positions, cash out their physical holdings, and step aside, transferring their wealth at suppressed prices to the very institutions that triggered the collapse. If the mechanics behind the sell-off are starting to connect for you, if you recognize the pattern, take a second and hit subscribe, because the layer underneath this one is where everything changes. Now here's the paradox that the futures market cannot explain away. While paper gold was in free fall, premiums on physical coins did not drop. In many cases, they rose. The American Eagle, the Canadian Maple Leaf. Dealers reported shortages, with wait times stretching into weeks. This is the market telling you two different stories simultaneously. The digital price says panic. The physical market says scarcity. Both cannot be true at the same time. And the physical market, the one dealing in actual atoms, has a track record of winning that argument eventually. The stress is already visible inside the exchange warehouses themselves. Registered gold, the metal actually earmarked for delivery, has been declining steadily. Meanwhile, the number of contracts standing for delivery is climbing. More traders are saying, I don't want cash settlement, I want the metal. This is the structural crack in a fractional reserve system that depends on participants never collectively asking for the thing they were promised. While the derivatives market runs its playbook of manufactured sell-offs, the sovereign sector is telling a completely different story with its checkbook. China's central bank has added to its gold reserves for over 15 consecutive months and shows no indication of slowing. But Beijing is not buying paper claims on a New York exchange. It is taking physical delivery and shipping bars directly to the mainland, removing that supply from the global float permanently. Russia, India, and a growing list of emerging economies are executing the same strategy, converting dollar-denominated treasury holdings into metal they can hold in their own vaults. The catalyst was watching foreign reserves get frozen during geopolitical disputes. The lesson every central bank absorbed was simple. Assets held inside someone else. This system can be weaponized against you. Gold in your own vault cannot. This sovereign accumulation is colliding with a supply chain that was already fracturing. Silver presents the most acute case. For 3 consecutive years, global consumption has exceeded mining output. The deficit is being bridged by draining above-ground stockpiles in London and New York, inventories that are now approaching critical thresholds. When those reserves are depleted, there is no buffer. And unlike a software company that can scale production overnight, a new silver mine takes a decade or more to bring online from discovery to first pour. The supply response to a shortage is not slow. It is geologically constrained. Industrial demand is compressing the timeline further. Solar panel manufacturing consumed over 190 million ounces last year, and next-generation photovoltaic designs are increasing the silver content per panel to boost efficiency. Electric vehicle production, defense electronics, medical devices. Silver sits at the intersection of nearly every advanced manufacturing sector. This is not discretionary demand that evaporates in a downturn. When Apple or Samsung or a missile guidance contractor needs silver, they pay whatever the market asks. Now layer in the fiscal dimension. The United States national debt has crossed $38 trillion. Annual interest payments have surpassed $1 trillion, more than the entire defense budget. The Federal Reserve faces a binary trap with no clean exit. Hold rates high to fight inflation, and the interest burden becomes mathematically unserviceable. Or cut rates to ease the pressure and unleash a second inflationary wave that eviscerates purchasing power. Every historical precedent for this kind of sovereign debt spiral ends the same way. The central bank eventually monetizes the debt, printing currency to cover obligations that tax revenue alone cannot fund. This is not the environment where precious metals decline. This is the environment they were designed for. Everything I have laid out so far, the paper-physical divergence, the sovereign accumulation, the structural deficit in silver, the debt spiral, these are the tectonic plates. Now let me show you the trigger mechanism. The Basel III banking regulations, now in various stages of global implementation, have quietly reclassified how banks must account for gold on their balance sheets. Allocated physical gold, metal you can point to in a specific vault, now qualifies as a Tier 1 asset, equivalent in regulatory terms to cash or sovereign debt. But unallocated gold, the paper contracts and ledger entries that bullion banks have used for decades to maintain enormous short positions, carries a significantly higher capital charge. Maintaining those positions just became dramatically more expensive. The early evidence is already visible. Open interest on the futures exchange has been declining, and commercial banks are steadily reducing their net short exposure during sell-offs. They are not exiting the gold market. They are migrating from the paper side to the physical side, accumulating real metal while publicly describing gold as an irrelevant relic. The gold-to-silver ratio sits near 85 to 1. The historical average hovers around 60. During major precious metals bull markets, it is compressed to 15. If gold merely holds its current price and the ratio reverts to its long-term mean, silver doubles. But gold is not holding still. It is hitting all-time highs in yen, euros, and pounds. The dollar's relative strength has masked gold's performance for American investors, but that mask depends entirely on interest rate policy. The moment the Federal Reserve signals a pivot toward cuts, the dollar weakens, and gold reprices in dollar terms simultaneously. Here is the question that sits underneath all of this. If the institutions managing trillions of dollars are quietly rotating into physical metal, reducing their paper exposure, and preparing their balance sheets for a world where gold is a primary reserve asset, why is the retail investor being told to hold bonds yielding negative real returns? Sit with that for a moment. Then tell me in the comments what conclusion you draw. The options market is flashing something remarkable. Deep out-of-the-money call options on gold, contracts that only pay off if the price surges dramatically in a compressed time frame, are being purchased in unusual size. Someone with significant capital is positioning for a rapid repricing event. The commitment of traders' data confirms the pattern. Commercial banks covered short positions aggressively during the recent dip, absorbing the panic selling from retail participants. They bought exactly what they shook out of weaker hands. This is not speculation. It is exchange-reported data showing institutional positioning that is diametrically opposed to the narrative being broadcast to individual investors. We are witnessing the early stages of a systemic repricing that moves in one direction, away from paper promises and toward physical reality. The BRICS alliance is constructing trade settlement infrastructure with commodity backing at its core. Saudi Arabia has publicly signaled willingness to accept non-dollar payment for oil, fracturing a petrodollar arrangement that has underpinned American monetary hegemony for half a century. These are not fringe developments. They are documented in official communiques and bilateral trade agreements, reshaping the architecture of global finance in real time. The regional banking stress that erupted last year is not resolved. It has been sedated with emergency lending facilities carrying expiration dates. When those facilities wind down, the underlying fragility resurfaces. Every intervention required to stabilize the system demands the same medicine, liquidity creation, which is a clinical term for currency debasement. Each round of it widens the gap between what a dollar claims to be worth and what it actually purchases. The cost of extracting an ounce of gold from the earth is climbing, driven by energy prices, labor constraints, declining ore grades, and environmental permitting timelines that now average 16 years from discovery to production. There's a hard floor beneath gold's price set by the physics and economics of mining. Below that floor, mines shut down, supply contracts, and the price corrects upward by force. The ceiling, however, is set by monetary policy. And every central bank on the planet is running the same playbook of expansion. So where does this leave you? Not as a spectator to an abstraction about institutions and exchange warehouses, but as someone whose savings are denominated in a currency that is being deliberately diluted to service debts that can never be repaid through growth alone. The choice is not between optimism and pessimism. It is between understanding the mechanism and being subject to it without knowing why your purchasing power erodes a little more each quarter. Gold and silver are not predictions. They are not trades. They are the only financial assets in existence that carry zero counterparty risk. No government, no bank, no institution needs to remain solvent for them to hold value. That distinction is academic in stable times. In the period we are entering, it becomes the most important characteristic an asset can possess. $920 million. That was the price of admission to understanding that the number on your screen and the value of the metal in your hand are not the same thing. The institutions paid that fine and kept building their positions. The question was never whether the paper and physical markets would reconcile. The question was always whether you would be positioned on the right side when they do. The reconciliation is no longer theoretical. The inventory is draining, the regulations are shifting, the sovereign buyers are not waiting for permission. The only variable left is you.